Welcome everybody, and thank you for joining the Wilshire Finance Partners year-end 2014 investment presentation. My name's Andrew Lucas. I'm the Vice President of Investments here at Wilshire. If you're joining us through the internet, you should now see the presentation on your screen. Audio is also available through your speakers or by calling 562-247-8321. Again, that number is 562-247-8321. If you experience any problems viewing or hearing the presentation, please call technical support at 855-352-9002. Please note that we will also be recording this presentation and it will be made available within 24 hours on our website at www.wilshirefp.com. Again, wilshirefp.com. Then also a friend or an associate who may have an interest in learning about these type of investments, we encourage you to share this presentation with them. We also encourage you to ask questions. Throughout this presentation, you will be able to ask questions by typing them in the box in the upper right-hand corner of your screen. We will answer all questions at the end of the presentation. All right, real quick, just on to some housekeeping. The purpose of this presentation is to provide a summary of the results of the WFP Income Fund, the WFP Opportunity Fund, as well as other investments offered by Wilshire Finance Partners. This presentation is not an offer to buy or sell securities. Any securities offered by Wilshire Finance Partners will be in reliance on certain exemptions under federal and state securities laws. Whether the Securities Exchange Commission or any other federal or state agency has passed on the merits of or given approval to any securities or the terms of any offering. Any purchase or sale of securities may only be made to accredited investors who receive and review the respective private placement memorandum and related documents. During this presentation, we will be making certain forward-looking statements. Those statements are based on the views of Wilshire's principals as of the date of this presentation. While we believe these statements are accurate, they are subject to change and based on a number of factors that are beyond our control. Any investment in trust deeds, the WFP Income Fund, the WFP Opportunity Fund, or other investments offered through Wilshire involve risk, and investors should read the private placement memorandum and accompanying information carefully prior to investing. And past performance is indicative of future results. All right, well, now that that's out of the way, at this point I'd like to introduce Don Pelgrim. Don's the CEO of Wilshire Finance Partners, and he's also the manager of the WFP Income Fund and the WFP Opportunity Fund. Welcome, Don.
Andrew, thanks for the introduction, and I'd like to take a quick moment to welcome everyone to the call. Thank you for taking time out of your busy day to join us here this morning. As I look at the attendee list, I see that we have a number of wealth managers and advisors and investors who are working with us and investing in the fund, so thank you and welcome, and thank you for joining us. It also looks like we've got a couple of new investors as well as a couple of new advisors, and maybe one or two folks that are just out there curious about what we do and wanting to learn about Wilshire and our funds. So again, welcome to the call as well. In order to set expectations about the call today, there are a couple of topics that I'd like to cover. The first is I'm going to give a quick overview of Wilshire Finance Partners, who we are, what we do, and our approach. And this will help some of the new folks on the call understand what we do, and it may act as a refresher for some of the folks who have already been working with us over the years. I'll then turn to the summary results for both of the funds, and during that segment we'll get into some of the important metrics and how we're measuring the funds, and we'll also provide a couple of examples of transactions that are in each of the funds so that the people on the call can get a better understanding of how the funds operate and how we're investing within the funds. Then lastly, I'm going to touch very briefly on some of the broader market observations. We'll talk about what's occurring in the real estate lending space. We'll also talk about the news that's in the marketplace about alternative investments like the WFP Income Fund and the WFP Opportunity Fund. And then lastly, I'll try to tie it all together and talk about how Wilshire is approaching these dynamics. So as a backdrop, Wilshire Finance Partners was formed in 2008. And after a career in banking and law, I joined as an owner and the CEO of Wilshire in 2011. And over the years, what we created was a boutique environment with an institutional approach. and you'll see that as we get into how we're managing the funds. We have a number of experienced professionals associated with us, both at the staff and the advisory board level, and they represent different disciplines, including lending, banking, law, accounting, finance, and others. And our overriding goal as a company is to provide strong risk-adjusted returns for our investors. Wilshire Finance Partners is a collateral-based lender. So fundamentally, each of the loans that the funds invest in are real estate loans or other transactions that are generated by Wilshire Finance Partners. Therefore, those loans, the transactions, and the investments are essentially the building blocks of each of the fund's portfolios. Now, Wilshire, as a company, makes short-term bridge loans to real estate investors. And we call those loans bridge loans because unlike longer-term financing, these loans are primarily used to bridge the gap in timing or financing that's left in the marketplace by institutional lenders and fills the gap or the need that real estate investors have in the marketplace. And as you can see, we're generally targeting net returns to our investors of between 7 and 8% on those loans. In these individual trust deeds, we generally lend in first lien position. However, when we talk about the WFP Opportunity Fund, you'll see that we also do subordinate financing. And but generally, we have more conservative loan-to-values on the loans that we've made. You'll see that typically it's a 65% loan-to-value, which generates about a 35% protective equity cushion. Now, the primary difference in our approach as compared to traditional lenders, including banks, finance companies, Fannie Mae or Freddie Mac, is that our primary focus is on the collateral of the property and the cash flows from the property. So while traditional lenders will normally focus on factors in their loan approval decisions such as the borrower's credit and their capacity, such as their job or their income to be able to service the debt or support the debt, and that's heavily relied upon by those traditional lenders to justify longer loan-to-values and higher, longer loan terms and higher loan-to-values. Wilshire conversely goes in a different direction. We're making shorter-term loans with lower loan-to-values, and again, our primary focus is on the collateral value and the cash flow. So stated another way, when real estate values shift lower or a borrower can't pay you for whatever reason, our lending philosophy is that it's better to have more equity ahead of our loan to buffer against that kind of downside risk. Here's another way to look at it in terms of the difference between Wilshire's approach and traditional lending. You'll see that many traditional lenders may only require 10 to 20% of a borrower's equity in a transaction, and sometimes even less than that. And in today's environment, we're seeing many banks are now competing with each other for loans, and those loan-to-values may creep higher on certain types of properties or for certain types of borrowers. Conversely, when Wilshire makes a first trust deed, we're generally requiring that the borrower have at least 35% equity in that property. And here's why. If there's an adjustment in property values or the borrower simply doesn't pay you, the borrower's equity creates a cushion or a buffer against that downside risk and a loss of principal. And if you recall, in the 2006 to 2009 timeframe, there were a number of people. Well, there were some people who were gaming the system clearly, but there were also a number of good people who had good character, and they wanted to pay their loan, they wanted to work with their bank, but they simply couldn't. So therefore, having a larger equity cushion essentially at the end of the day gives you two sources of repayment. First is that the loan pays as agreed, or the second is that you may need to foreclose against that property, and in which case you'd want to have a larger equity cushion to protect your principal investment in that loan. But interestingly, that equity cushion does a couple of things. Because borrowers have skin in the game, even if there's a decrease in property values, they still may take steps to protect their investment in that property because they still have some equity in that property. So it might be the sale or refinance of the property as opposed to going through the foreclosure process. And what that does is it ends up providing a higher quality loan asset for these portfolios of these funds. So ultimately, we believe that Wilshire's lending approach provides a number of different benefits as compared to other types of lending. We see higher yields, and as you'll see as we get into the fund's good performance history, we're able to generate better predictable returns. and we're able to quantify that protective equity cushion. We're able to see that in our underwriting. So with the individual loans as building blocks, Wilshire offers a number of investment options to our investors. The first is we've historically made investments in individual loans or trustees, and we've sold those off to individual investors. We then created managed accounts, which is where we had the ability to manage larger pools of money or separate pools of money for larger investors. We've been involved in joint ventures where we partner with strong sponsors in real estate transactions, and we formed the WFP Income Fund, which is an investment pool of the first trustees and mortgages that provides diversification and stable cash flow for its investors. And we also created the WFP Opportunity Fund, which seeks a higher risk-adjusted return in this market on real estate-based investments. So with that as our backdrop, let's take a look at the WFP Income Fund and its performance. The WFP Income Fund is effectively a diversified pool of first mortgages and trustees, just like the ones I started to describe. And it's designed to be the more conservative of our funds, and it seeks to provide stable income and principal protection for its investors. Now, I want you to remember that concept of stable income and principal protection when we start to talk about the broader market a little bit later. And as you'll see, as we drill deeper into the fund, that it's provided higher predictable returns as compared to other short-term fixed income investments. It also provides a protective equity cushion that's built into each loan within the portfolio and then the overall portfolio itself. As designed, the fund has a low or little correlation to the stock market, the bond market, or interest rates. And that's a second concept that I want you to remember when we talk about the broader marketplace. We hope that you find that the fund is easy to understand. It's a pool of loans. And these loans, unlike other alternative investments in the marketplace, which may be secured by commercial paper or accounts receivable, these loans are secured by a hard asset. We've got a deed of trust against real estate. And the fund should act as a portfolio diversifier for those of you that are looking to diversify your fixed income segment of the portfolio. And that's the third concept that I want you to remember, specifically when we talk about alternative investments a little bit later. The fund is only open to accredited investors, and the initial minimum investment is $100,000. So let's talk about the performance metrics. Well, before we do that, how did we do in 2014? Let's talk about Fidelity Investments and being added to the Alternative Investments platform and the TD Ameritrade platform. In 2014, we accomplished a lot. We were added to both of those two platforms, and the QSIP numbers for each of those platforms are on the screen for you. Now, in order to be added to those platforms, we needed to have a registered investment advisor or a wealth manager essentially recommend the fund for inclusion. Then we needed to go through a due diligence process with each company for approval on their platform. So now that we've been approved on those platforms, we're available for direct investments, in other words, non-retirement account investments, as well as investments through your retirement plans across Fidelity and TD Ameritrade. So now, as an investor, you can invest through your advisor at TD Ameritrade or Fidelity. You can work with your independent registered investment advisor or your wealth manager, or you can invest directly through Wilshire. With respect to specific measurements, our assets under management continue to grow through 2014, and we currently have around $21 million in assets under management in the fund. We hit our target return of 8.01% net annualized on a non-compounded basis, and we generated consistent cash flow for the investors who are receiving monthly dividend checks from us. For those investors who elected to reinvest, they would have received about an 8.31% net compounded return for 2014 for the full year. The loan-to-value and protective equity cushion were on track, about 62% in the fund, which means a protective equity cushion of about 38%. Good granularity, good diversification within the fund. We had a loan size range with a top end of $1.3 million and an average size loan of just over $400,000. And you can see here that we had good performance within the fund as well. All loans were performing, no investor losses. Now, at this point, I want to pause for a second and say to those investors who were in the fund as investors in 2014, you should have received a copy of the fund's audit and your K-1 last week. If you did not receive those documents, please reach out to our office, and we'll be happy to send you another copy of that. If you're a new investor in the fund in 2015, or if you're an investor or advisor thinking about an investment or placing clients in the fund, please contact our office. We'd also be happy to send you a copy of the 2014 audit. Another cut at the portfolio, the fund had 0 non-performing loans. 54% of the loans were in residential properties or secured by residential properties, 46% secured by multifamily and commercial real estate loans. All of the loans were in California, but were pretty well diversified geographically within the state. As you know, California is a large state and has a variety of different economic subdivisions within the state, and we're pretty well diversified throughout the state. Now, we're often asked about liquidity, so I wanted to pause and talk a little bit about that. Now, the WFP Income Fund has a 1-year hard lock provision, and thereafter it permits redemptions every 90 days, subject to certain restrictions. However, when I think that a number of investors look at real estate-based funds or funds that have a loan portfolio, some of them start to think, well, those are longer-term investments. They're primarily illiquid assets in the portfolio, and that's not necessarily the case here with the income fund. As this slide shows, the fund was strategically designed to generate internal liquidity. The fund sits on cash, and it also sits on some cash equivalents, and I'm using the subscription account and investors waiting to be added to the fund as cash equivalents because while they're not in the fund does have the capability to, on a short-term basis, borrow from the subscription account and pay the investor a return provided the investor is accepted into the fund and will go in on the first of the month. And that might be a couple of days of interest for those investors. So that becomes a cash equivalent. Now you'll see that in the target there's a pretty wide range, 0.8% to around 10%. And that's because of the need for and the use of cash becomes a timing issue for me as a manager in the fund. And I want to manage the fund so we've got enough cash to provide distributions to our investors on a consistent basis so that we're managing redemptions, so that we're able to make new loan investments within the fund, but not to sit on so much cash that it affects the returns to the fund's investors. In the middle of the chart, going back for one quick second to the actual number there at 10.63%, that includes some of the money that was sitting in the subscription account going into the fund as of January 1st. So that's why that number is a little bit inflated there. Sitting in the middle of the chart, liquidity comes in the form of maturities of the underlying loans as well. So like you might see somebody laddering the maturities of bonds in a short-term bond portfolio, we've done the same thing with the maturities of our loans within the fund. And what that does is it creates a natural return of cash to the fund as loans repay or as loans are turned over within the fund, and it creates liquidity within the fund. At the bottom of the chart, we see that the target and actual rate of repayments, which differs a little bit from the laddered maturities in the fund. It differs because we don't have prepayment penalties on our loans, so therefore the borrowers have optionality. They have the option to repay those loans a little bit early. So what we saw in 2014 was about 45% of the portfolio rolled over, which again generated some additional liquidity within the fund. Now lastly, although it's not on the chart and the fund is not required to do so, the fund also has the option to potentially sell loans to generate liquidity. So when we think about liquidity within the fund, it comes in the form of new investments, laddered maturities, loan repayments, and again, potentially loan sales. Lastly, we can also manage the issue of having too much liquidity so we don't hurt returns by doing a couple of things. The first is we can slow the rate of new investments in the fund. we can start making longer-term loans. And we can also start instituting prepayment penalties to slow that rate of repayment or that rate of roll within the fund. So the point is that the income fund is a short-term investment vehicle that creates internal liquidity within its portfolio. In the next couple of slides, I want to give you some examples of the types of loans that we've put in the fund. And this first one is a loan that was referred to us through a bank. And this bank was working with the client. It was an existing client of the bank, and they were putting together a C&I loan, or a commercial and industrial loan. And that's essentially an unsecured loan. But in this case, it was a hybrid. They were going to be collateralizing the loan with some of the borrower's real property, and they were also going to give them an unsecured portion of the line. But as the banker was doing their underwrite, they realized that it was going to take them about 120 days to complete their underwrite and put that facility in place for the borrower. Now, this particular borrower had a challenge. He was in escrow to buy another piece of commercial property, and he couldn't wait that 120 days to close that escrow. So the bank referred the loan to us, and we were able to take about 3 pieces of collateral out of that portfolio and cross-collateralize those with a new first trust deed at a 65% loan to value, provide the cash that the borrower needed to close that escrow, and generate a nice return for the fund at about 9.5%. Ultimately, what happened was the bank put the facility in place, and that loan was repaid back to us fairly quickly, about 90 days. So that's a pretty good example of a bank referral. Another example is where we've got a real estate investor. They identified a terrific opportunity to buy a multifamily property, and they needed to pull some cash out of one of their other rental properties in order to swing that into the escrow and then get a new loan against the multifamily property to close against it. So what Wilshire did was we created 2 separate loan transactions where we financed and pulled some cash out of the existing rental property, swung that money directly into the escrow for the multifamily purchase, and then put a new loan to value or a new loan against the multifamily property, and we sat at low loan to values on both of those properties, and again generated a nice return for the fund. Here's a view of the income fund return and the net asset value over 2014. As you can see, month over month, the fund generated a consistent net annualized return, and actually finished the year at 8.01% for the full year on a net basis. And the fund's net asset value was pretty static at $1,000 a share throughout the entire year. So with respect to the WFP income fund, a couple of takeaway points are that the fund was able to generate strong, consistent returns in 2014. The fund is built around a portfolio of shorter-term loans with lower loan-to-values and generating higher yields. And we were able to get a good diversification mix in the portfolio to generate the performance that we just saw on the previous slide. So with that, I want to move on to the Opportunity Fund. Now, the Opportunity Fund is a professionally managed fund of debt and equity investments, but it differs in risk profile than the WFP Income Fund. And the objective of this fund is to seek higher risk-adjusted returns on its real estate investments. So in a word, we're trying to be opportunistic in this fund, but at the same time, we're trying to be prudent in how we're deploying capital and making our investments. So as a result of the underlying investments, which we'll talk about, there's a mix of them, and the unit value or the NAV of this fund and the cash flows of this fund will fluctuate on a quarter-to-quarter basis based on those underlying investments in the portfolio. Like the WFP Income Fund, the WFP Opportunity Fund is open to accredited investors only. The difference here is that the distributions in the Opportunity Fund are on a quarterly basis versus monthly. So how did we do? Well, in this fund, we were below our target annualized return. Our target return was 12%, and we hit 10.34% for full year. Now, remember what I said a moment ago about having too much liquidity. Well, as the fund manager of this fund, in the first 2 quarters of 2014, I didn't see investment opportunities that I found to be attractive for the fund. So we sat on about 50% of the fund's assets in cash for those first 2 quarters. So in the first quarter, we generated around a 7.71% return, and then that dipped in the second quarter to about 5.4%. Late in the second quarter, we started to identify a series of opportunities that allowed us to deploy capital efficiently into several short-term participating loan investments. And as a result, we saw a pretty nice pickup in the third quarter at around 17%, and then overall for the year, we finished off at about 10.34%. Now, for those of you who are investors in the fund and were receiving distributions, if you were in it for the full year and you're looking at your statements and you're saying, well, you know, I didn't get cash distributions equivalent to 10.34%, that's because you received cash in the form of dividends from available capital or available cash when gains were actually realized on the underlying investments in the fund. So as we received interest payments on the loans that we made, or as we received our participating interest on the gain of the sale from the participating loans that we made, that realized gain was distributed in the form of dividends to the holders in the fund. The unrealized gain from the underlying investments is embedded in the unit price and through the calculation of the net asset value. So in later slides, you'll see that there's distributions, and then you'll see a little bit of change in the net asset value of the fund over time as well. So again, the changes and the mix of the portfolio will reflect both in the distributions of the fund, and will also reflect in the net asset value of the fund quarter over quarter. As you can see, we did a series of smaller transactions in the fund, and that's reflective of the relatively smaller amount of capital in this fund and the need or the desire to have diversification within this fund as well. The duration of the investments in this fund was also very, very short. We actually had one investment, which was a participating loan that turned over and closed in 20 days, but that's sort of an anomaly. That's usually not the case, and those type of investments are normally 90 to 180-day type of closing or turnover. So short-term investments like that shouldn't necessarily be expected in the future. Overall, we had good performance in the loans in the fund, 0 non-performing loans. And again, I want to make the announcement to the investors in this fund. You should have received your audit and your K-1s last week. And again, if you haven't, please contact us. We'll get you a copy. And I want to make the same offer to the people who are on here as a new investor in this fund in 2015 or thinking about an investment in the fund. Please contact us. We'd be happy to send you a copy of the audit and other materials as well, so you can get a look at that. Here's another cut at the loan portfolio. Again, 0 non-performing loans. 100% of the portfolio was in loans versus equity investments. However, when I get into the examples, you'll see that the participating loans perform a little bit like equity and have equity-like returns. All of the loans were in California. The majority of the loans were in Los Angeles County. Participating loans represented about 45% of the portfolio, with trust deeds, second trust deeds, B notes, rehab loans making up the balance of the investment portfolio. Right, so we talked about the fund and its performance and some of the investments it's making, but what the heck is a B note, and how does a participating loan work? So before I get into the details of those segments of the portfolio, and as we start to drill down into those metrics, I want to back off a little bit and talk about what those investments are. A B note simply functions like a second trust deed. And some of you might be thinking, well, if it functions like a second trust deed, why not just do a second trust deed in the first place? Well, a couple of reasons. The first one might be optics. So, for example, as opposed to working with a borrower and going to them and saying, well, congratulations, we approved you for a new loan. We're going to put a first trust deed against your property, and the rate's going to be 9.5%. And again, congratulations. We've also approved you for a new second trust deed, and the rate on that's going to be 12.75%. the reaction might be one of choking on behalf of that borrower. But let's say you can go back to that same borrower and say, hey, congratulations, we approved you for a new loan in the full loan amount that you requested, and we need to charge 10% on that loan because we're giving you a little bit more than we typically provide. So although the economics are the same, the borrower perception becomes a little bit different. Another reason is that some of it is structural and some of it's legal. In a B note, what we're doing is we're taking a single note and a single deed of trust, that's the deed of trust being recorded against the property, and then we split that note behind the scenes. So the structure really becomes irrelevant to the borrower. In their eyes, they've got a first mortgage or a first lien against their property. But in a foreclosure context, the holders of the A note and the B note are acting together in accordance with a pre-negotiated contractual arrangement. In other words, when we split the note, it's by contract behind the scenes, and each of the A note holder and the B note holder have negotiated their positions in that note. So regardless, the holder of the B note becomes a subordinate in a subordinate lien position to the holder of the A note, so it functions more like a second trustee than anything else. Now, as you can see here, because the holder of the B note is subordinate, they're getting a higher portion of the return as compared to the A note holder. And that's because the A note holder is in a superior position. And because it's in a superior position, with in effect a lower risk exposure, it will take less of the note rate. In other words, it will haircut the note rate to subsidize or support the greater yield being provided to the B note holder. So the result is that the note is split. There's a shifting of the economics and a shifting of risk allocation so that the A note holder sits in a similar position to a first trustee holder, and the B note holder sits in a similar position to a second trustee holder. So let's take a look at that segment of the portfolio. So when we start to drill down and we look at the B notes and the seconds, the B notes had a combined loan-to-value range of between 58% and 77% of the property's value. And the B notes, based on the structure, provided a pretty nice gross coupon and return to the fund, between 13.41 and 16.98%. The second trust deeds also had sort of a similar metric in terms of the CLTV, although slightly lower, of between 37 and 68%. And the second trust deeds threw off a gross coupon of between 11.25% and 16%. So both segments react pretty similarly, and both providing pretty good returns for the fund. Now, a participating loan is similar to a joint venture, but it's structured as a loan. Now, under a participating loan, effectively what happens is that the Opportunity Fund provides cash to the borrower or the sponsor of that transaction, and then the borrower or the sponsor is responsible for managing the property and doing the work, doing the rehab. And what we're doing is we're using this structure with strong, experienced real estate investors in lieu of a joint venture. And we structure these transactions as loans because there's more favorable legal, accounting, and tax benefits for the fund as compared to a joint venture. So when we enter into these arrangements, we enter into a sharing agreement where there's a sharing of profits once the transaction sells or once the property sells. And all of that's done through a profit allocation section of provision in our agreements, and sometimes those are called waterfall provisions in the agreement. And an example of a waterfall might be where the profit allocation first goes to the cost of the transaction. So when you sell the property, you have to pay commissions, you have to pay settlement charges and whatnot, and those come out of the escrow first. Secondly, there would be a return of the capital invested by the fund into the project. The fund might get a preferential return on its investment first before ultimately there is a splitting of net profits. So after the work is completed, after the property is sold, the gains and the interest is realized upon the completion and the sale of the property and are distributed down through the fund. So again, when we were talking about the net asset value and how that may not reflect some of the gains that are being received, there's accrued unrealized gains in some of these projects that are being reflected in that net asset value. Looking at this segment of the portfolio, Participating loans were a pretty good driver of the returns for the fund. We did a series of investments in fix and flip transactions with pretty quick turnover. These were relatively small transactions, somewhere between $155,000 and $743,000, with an average capital commitment below $400,000. We're pretty much providing the cash on these transactions, and we worked with a good sponsor with a 30-year track record on these deals. Now the range of investment return is very, very wide. 337% was an absolute grand slam home run. That's sort of off the charts here, but most transactions in this space will generally generate returns between 18 and 30% on an annualized basis. Now I do want to point out that opportunities in this space are not as abundant as they once were, and we're seeing some price compression in the returns, but we still expect to see pretty healthy returns with the good sponsors that we're working with on transactions in this segment. So after a slow start in the first couple of quarters, the fund started to see more good transactions than we had capital available. So as a result, the fund borrowed money from the subscription account on a couple of instances, and we paid that investor a 4% return on their investment until they entered the fund and started to receive the fund yields. And as the manager of the fund, Wilshire Finance Partners also lent money to the fund as well. Now these were generally small borrowings that were repaid fairly quickly through the fund. And the result of these borrowings was, in fact, able to help bolster the returns in the fund, because we were able to bring in a couple of more opportunities and investments that we would have passed on because we didn't have the capital within the fund. So on a move-forward basis, this fund may still continue to use leverage in the future if we're able to get good beneficial results for the fund as well. Here's a view of the WFP Opportunity Fund returns and the net asset value over 2014. Now, as opposed to going quarter by quarter, I elected to spread these returns month by month to show how the interim returns occurred within the quarter as well, and to avoid some of the spikes that we were seeing, because it's a little bit more smooth than it was spiky. There was a rocky start to the year, as we see in the left-hand corner here, but we really started to see pickup in early third quarter of 2014, and then ultimately, again, finishing the year with 10.34% net annualized for the full year. We also saw a little bit of a pickup in the net asset value of the fund, but again, the fund was primarily distributing most of the available cash each quarter that it received in realized gain in the form of dividends. This fund is not designed to be a growth-oriented fund, in other words, growth in the NAV, as much as it is generating cash returns for investors and distributing those cash returns in the form of dividends as those gains are realized. So we'll see some fluctuation in the NAV, but most of the distributions will come in cash. So with respect to the WFP Opportunity Fund, we sort of sat on the sidelines for part of the year, but I think we had a pretty strong finish. We're using investment and structuring techniques like B-notes, second trust deeds, participating loans, and other techniques to generate higher returns for our investors. And as we continue to look at opportunities in the marketplace, we will employ other investment strategies and techniques to generate returns as well. So we might look at things like transactional financing. We might sell loans and retain servicing or interest strips. We might do project repositioning. We may revisit joint ventures, direct real estate investment, and other related investments. So now that we've given a little bit of an overview of the types of investments in the funds and how the funds have done overall, I want to take a quick look at the broader market. I want to talk briefly about alternative investments. I want to look at what's occurring in the real estate lending space. And then I want to discuss briefly how Wilshire is approaching these dynamics on a move-forward basis. So moving forward, what are we thinking about? Well, 6 months ago, we started to see a lot of chatter in the marketplace. The market was worried about investors starting to quote-unquote sober up and that the market was overvalued. And we saw a lot of rockiness in the markets, the stock markets, in the third quarter. Yet, as we roll forward, the market continues to hit new highs. But the consensus seems to be that we're going to experience a little bit more market volatility, and some are still a little concerned about a correction. We haven't had a correction for a number of years, and we maybe do. Others are looking at factors that may influence the market, things that are happening in Europe and in Asia. And those things might have an influence on the market on a move-forward basis. But interestingly, while the stock market at this point doesn't seem to care about everything that's going on abroad, there's a flight to quality in the bond market, and demand is helping to keep a number of interest rates depressed. And that's not necessarily a good thing for fixed income investors that are seeking cash flow. What's currently happening in the real estate market, the real estate loan market in particular? Well, today we're seeing a very interesting dynamic in the single-family investment market. Several years ago, we had a lot of distressed assets in the marketplace, and there were a lot of opportunities there, but a lot of those problem assets have now been resolved. And as a result, there are fewer good deals in the market. Margins are starting to compress for those real estate investors. However, what we're also seeing is that there are good sponsors out there that are still finding good deals. These are guys who've been through several real estate cycles, and they know how to react and act in these kind of markets. Now, interestingly, even though there are fewer deals, more money has flowed into that space than ever before. And we've also started to see subprime loans come back into the market. So when you start to have more money supply than demand, we're starting to see some lenders chase deals. Some of them are going after those transactions with much higher loan-to-values. They're lowering their yields. They may be opening up or loosening up their underwriting standards. So in effect, they're taking on a little bit more risk. In the multifamily and the commercial real estate segment, we're seeing lots of strength. Now, depending on who you read, multifamily values are either at their peak or pretty close to it. However, there's a good segment of the marketplace that believe that the market fundamentals that are out there will support higher values still. In my view, I think affordability becomes an issue at some point, and that to me is about real wage and job growth impacting affordability on various types of residential real estate. So at some point, there's got to be a cap to what people can pay for their properties or are willing to pay for their leases or mortgage payments. So there may be a widening of cap rates, and that is inevitable at some point. It's really more of a matter of when at this point. In other segments of the marketplace, specifically commercial real estate, we're experiencing different dynamics. We're seeing some better news in office with more absorption occurring for vacancies as the economy continues to improve. Retail along the coast has improved, and local B-quality centers are fairly resilient, at least in California. In warehouse and light industrial space, we're seeing that there's high demand for that. Businesses are starting to push out from core business areas and transportation hubs and portals in order to find suitable product for their businesses, suitable real estate for their businesses. We're also starting to hear a lot about alternative investments, and alternative investments being a key to a piece of an investment portfolio. And one example is that at the Investment Management Consultants Conference in San Diego, Goldman Sachs was there, and they started weighing in, and they were saying that now's the time to start looking at alternative investments, and specifically investments that provide a return. And it's more about diversifying versus dabbling. If you're just checking the box in your portfolio and saying, yeah, I've got alternative investments, that's really not what they were describing there. Their feeling was that many investors may be way too much or heavily weighted way too much in equity or bond risk. So there might need to be some adjustments that are occurring there. A more diversified portfolio is needed. In their view, it was maybe a little bit less equity, fewer bonds, and then some more alternative investments to have some balance within the portfolio. But the key question that comes out of that is which alternative investments? There's a lot of clutter in the marketplace. So there's alternatives with complex trading strategies. There's ones that rely on hedging. There are others that model and check and trade against multiple variables on different segments of the marketplace, and so on and so forth. So, you know, cutting through all the clutter, what is Wilshire doing through all of this? Well, in some respects, we anticipated a number of these dynamics. And through this market, we are continuing to seek and validate information and make informed decisions about the marketplace, about our business, and about our lending strategies. And we're making adjustments to our lending approach on a roll-forward basis. Now, while we've always stress-tested our underwriting, we're now viewing the metrics through a different lens based on what we're seeing in the marketplace. And we continue to maintain lending discipline, notwithstanding some of the things that are happening around us. Now, specifically, what does that mean? What does it mean with respect to the single-family marketplace? Well, with respect to single-family lending, we're not necessarily chasing that market or those companies that are increasing their loan-to-values and taking on, in our view, a little bit more risk. We are lending, but we're maintaining our lending discipline and how we approach lending in that space. Also, a couple of years ago, we elected to focus more and more on multifamily and commercial real estate lending to diversify our business and the portfolios of the funds that we manage. So if you recall in some of the prior slides, the portfolios we've got, we're already executing on that strategy, and we're starting to see more good opportunities than we have capital to lend, which is a good thing. So we're maintaining our underwriting and investment discipline in that segment, and we are passing on loans that we don't think are good investments, and we're further diversifying the investment portfolios across those different property types on a roll-forward basis. Although we're seeing some yield compression, we're still seeing some good risk-adjusted returns, and we're still seeing some good credit quality or loan quality within the portfolios. So how does all this information start to hang together, at least in our view? Well, the stock market continues to reach new highs, and again, volatility in the market seems to be a universal consensus. Fixed income investors are having some challenges in getting yield in the interest rate environment as interest rates remain depressed. We're seeing that the real estate market is still pretty robust, but there's a lot of capital chasing certain segments of the market. So in our view, a disciplined approach to lending is still needed in this environment. Alternative investments start to take center stage, and the question becomes which alternative investments. And some of the factors that the advisors are recommending for this segment include looking at investments that provide cash flow, that provide principal protection, that have low correlation to the stock or bond market, and provide some additional portfolio diversification. So summing it up for Wilshire, again, we had good performance in the WFP Income Fund and the WFP Opportunity Fund in 2014. And we also believe, like many, that the real estate market has firmed up, and we're hearing that optimism is at one of the highest levels that it's been over the last several years. So when you start to think of the WFP Income Fund and the WFP Opportunity Fund in the alternative, a couple of those key points I asked you to remember earlier in the presentation. Each of the funds, the WFP Income Fund and the WFP Opportunity Fund, should be viewed as short-term fixed income alternative investments in your portfolio. They are designed to generate higher returns with a consistent cash flow for the investors. They're also designed to provide certain downside risk protection. So in the WFP Income Fund, we're relying on that protective equity cushion of the underlying loans in the overall portfolio, and we're looking at diversification in that pool to provide some of that downside risk protection. In the WFP Opportunity Fund, we're using structure, we're using approach, and we're using diversification to help protect against some of that downside risk. Each of the funds has little to no correlation to the stock market, the bond market, or interest rates, and what we're finding is that our investors are starting to look at these funds as a way to further diversify their investment portfolios. So with that, we've covered a lot of territory here today, and I'd like to address some of the questions that might have been raised through the presentation. So I'd like to, at this point, open up the floor. And as I'm here, I'm struggling with looking for questions.
Hi, Don. I'm able to see a few questions. Sorry to chime back in. I'm not sure maybe if they popped up on my screen and not yours.
Sure.
I see one here. It says, moving forward, will you continue to only lend in California, or will you begin lending out of state?
Sure. That's a great question. The funds, each of the funds by design is designed to do lending and investments on a much broader scale geographically than just the state of California. So on a roll-forward basis, as we raise more capital within the funds, we will seek to diversify geographically. But that said, we're going to pick our spots by doing that. We're not going to simply lend across the board on any type of transaction that comes our way. Again, this becomes a piece of that lending discipline that we want to employ. So we'll pick particular states where we see opportunities to lend in segments that will provide us the returns and provide us with the metrics that we want to have within those portfolios.
Gotcha. Then I see another one right here. It says, why does the WFP Income Fund have a 1-year lock-in period and the WFP Opportunity Fund have a 2-year lock-in period?
Okay, sure. It's a function of the underlying investments in those portfolios. When we looked at the WFP Income Fund, the laddering of that portfolio and the attributes of the loans within that portfolio allow us to create internal liquidity on a more predictable basis and a more consistent basis than we might see in the WFP Income Fund, excuse me, the WFP Opportunity Fund. The WFP Opportunity Fund investing in participating loans and maybe some direct equity investments will at sometimes have a longer investment horizon or might have longer periods of time in order to have a realization event on those underlying investments in the portfolio. So it's a function of what's in those different separate pools, those different separate portfolios, and how quickly we might be able to realize gains or realize liquidity in each one of those portfolios.
Gotcha. Then I see one last question here. It says, successfully invested in individual loans previously. Why would I invest in the fund as opposed to individual notes?
Well, you know, individual notes and individual trust deeds is something that Wilshire has done since 2008, and we're still doing that. We still have investors that are investing in those individual loans. It's kind of like asking me who's my favorite child. I think that all of the loans that we make are good loans, and there are investors who like to invest in individual loans as opposed to a pooled investment. I think that both of them are good investments. The advantages of going into a pooled investment like the WFP Income Fund include things like the diversification that you would have through the fund itself. So as opposed to putting all of your money into a single loan or a single credit, you're able to spread that in the pool across multiple credits and further diversify your risk among a variety of different property types, a variety of different loans, maturities, and sponsorship, to name a few, as opposed to a single loan. The second thing is that you have the capability to reinvest dividends a little bit more easily in the fund as opposed to an individual trust deed. Unless, of course, you've got millions and millions of dollars in a managed account with us with multiple trust deeds. We've had investors that have had enough cash flow to take that cash flow and reinvest in individual notes. However, you know, with an average investment size in our fund of about $350,000, tough to do when you get that monthly cash flow, but you're able to do that more effectively and more easily within the fund. And that becomes important for people who are not only looking for a compounding effect on their investments that are non-retirement related, but for those investments that are retirement related, it's a more effective way to get that compounding effect on a tax-advantaged basis. So just a couple of benefits by going into the fund versus trust deeds.
Terrific. I don't see any other questions at this time. If anyone has any additional questions, you can type them into the top right corner of your screen. And if not, I guess we will wrap it up.
Well, I see one last question, and it says, can we add to our investment at smaller denominations than $100,000? The answer to that is yes. The $100,000 investment is the minimum initial investment. Thereafter, if you want to add to your investment in the fund, it would be at $50,000 or above. So the subsequent minimum investment is $50,000. So we've had investors come in at $78,000, et cetera, et cetera. So $100,000 on the initial, and then $50,000 or above thereafter. Okay, so with that, I think we have addressed most of the questions, but I do want to invite people who have questions and may want to have a direct conversation with us as opposed to having those questions answered in a forum like this. I invite you to contact us, reach out to us. We'd be happy to provide you with additional information or documentation to address those questions for you. So with that, I'd like to start wrapping this up. And as sophisticated investors and investment professionals that are on this call, we know that you have a lot of investment options available to you in this marketplace, and your time is very valuable. So we thank you for taking the time to listen to this presentation. And for those of you who are investors with us, we thank you for entrusting Wilshire with your investments. Have a great day. Thank you.